Hi, this is Ray Mullaney with Equity Risk Sciences. We're raising $20 million in a 506c offering. We are a science company, not an investment company. We measure the probability, magnitude, and timing of losses and gains. We focus on losses because that's where our most compelling story is for fiduciaries who have the legal responsibility to protect capital. That's why we call ourselves the America's Independent Stock Risk Rating Agency. The risk is no advisor puts a risk rating quantified based on science. They use their gut, they use beta, they use all kinds of highly unsophisticated rules. We have scientific rules that measure with enormous reliability. That is our case. If we measure something scientifically, we get a correct answer. Wall Street says buy something and it falls 90%. They act like nothing's happened. No other profession has that much leeway. So we are building technology for fiduciaries to meet the most demanding standards of professionals who have the highest ethic and dedicated to protecting their clients' capital. People don't know just how painful investing can be. And I'm going to point out just 3 periods. The S&P in 2000 was at one level, and 13 years later, it made 1%. But it hides how much pain there was in the interim. In that 13-year period, the market collapsed, it recovered, it collapsed, and it recovered. So nominally, investors made 1% over this 13 years. Adjusted for inflation, they lost 26%. Adjusted for fees, for commissions, for aggravation, how do you retire knowing this can happen? If you don't have risk ratings, this is exactly what can happen. The NASDAQ is even a worse loss. In the year 2000 in March, the market fell, I believe it was 78%. Yes, it recovered. And then it collapsed again. And yes, it recovered. In this 16-year period, an investor lost 27% adjusted for inflation, where they could have invested in something prudent and not lost a dime. In the year 2000, typical AAA or AA rated bond was earning 6% for a 10-year bond, or thereabouts. Now, going back even further from 61 to 82, adjusted for inflation, a retiree in 61 would have watched their money collapse. And investors believe erroneously, they're told erroneously, that stocks are a hedge against inflation. Nothing could be further from the truth. And we are a data science company. We are transparent in our data. No, we measure for a fiduciary the probability and magnitude of loss. And then we adjust for it by comparing it to the probability and magnitude of gain. This is the expected return. This is now governed by the DOL. Department of Labor is suggesting strongly that to fulfill your duty as a fiduciary managing ERISA plans, there are 6 things you must do. And even then, you still may have liability. We count those 6 things. We cover those 6 things. One of them is expected return, and that's based upon the probability of loss multiplied by the probability of gain and magnitude thereof. We are a science company. That is our position. First, we look at risk, and we look for probabilities and expected loss. This is, we've gone through this. Forgive me for redundancy. Thousands of companies are ranked every day by our system. Investment advisors tell people to buy stocks that are popular, stocks that are in the news, stocks by industry. But why not buy them by risk-adjusted return? Why not look through the entire database? And it might be only 2,500 or 3,500 that are investable, because many of these, most of these companies, a fiduciary wouldn't even consider. So maybe they'd consider 500 to 1,000. Strong companies at fair valuations. And that sounds like a conclusion, but it's a conclusion based upon science, based upon evidence, based upon data and statistics. So we provide risk-adjusted returns that are measured based upon science. Our ratings, unlike opinions, can be tested. So you can look back at any stock that we rated in the past 40 years and look at the rating and then look at the subsequent performance. We have 9 proprietary ratings and quite a few in the hopper. It is absolutely without precedent. No company, to our knowledge, has ever begun to answer these questions scientifically or published data on the results. Whether they did it scientifically or not, we know of no company that would publish a series of numbers on what their ratings were for IBM or GE or any company going back 2 years, 4 years. We go back 40. Now, In the most comprehensive study we have, this is a monotonic study. A scientist or a statistician, a mathematician would know exactly what this means. This is the Fiduciary Stock Navigator. Using this quantitative measure of risk and potential gain, we examined 433,500 ratings over the quarter of a century, and these are the results for holding the A pluses 1 year versus the Fs. To our knowledge, there's no company in America or in the Western world that has ever published a study anything like this. And we make all of the data transparent under confidentiality agreement to qualified professional. We have another study called the benchmark study. This has many hundreds of thousands of data points. And for anyone to spot check us, we're glad to share data under confidentiality with that too. But these results speak quite highly. A series of scientific tests which can be reproduced by an independent third party. Now, we have back tests, and those are important, but we have for the first time now a forward-looking record. A year ago, June 25, we arranged to have BX Partners create an index of our 40 top-rated stocks, for which we told them stocks are going to hold 1 year with no adjustments. That's in writing, it's time-stamped, and the results of those investments in 40 stocks, and you're welcome to see exactly what 40 stocks were recommended by our system 12 months ago. They're up, as of a week ago, 56% when the S&P is up 27%. So we've proven probability. We can measure the probability of loss and gain. We've proven magnitude. We know we can produce reports or ratings that suggest the magnitude on this series of stocks is going to be loss or gain is going to be higher or lower based upon the rating. And the frontier is timing. Now, James Simons at the Medallion Fund, he was the guy who created the best results from timing. I'm the founder, and I've been at this professionally for quite a number of years. I first got licensed in with the SEC and FINRA. Actually, it was NASDAQ, 1982, but I started buying stocks in 1976 while still in graduate school. There's a whole host of research on my background, what I've done, and my proudest professional accomplishment is having been sending reports to the SEC in the fall of 2000, and we have a letter from the senior legal counsel for the SEC acknowledging my warnings. Again, I want to emphasize that we're not an investment company. We're a science company. We do not provide suggestions of what you should do. We measure risk. We provide numeric ratings and alphanumeric ratings. Wall Street likes to tell you, just hold on. It'll come back. Well, I think that falls flat given the history of the market. It sometimes can lose 40, 50, 60% or more. And no retiree, unless they're gazillionaires, can afford to take such losses. Our company was designed to protect ordinary people. I've got a daughter who's a teacher and another one who's a nurse. They're not statisticians. They're not mathematicians. They're excellent at what they do, but they rely on somebody on Wall Street to protect them. And it is clear Wall Street has no intention of using science to protect their investors. That is not part of their makeup. That's in our DNA, both morally and professionally. So we've demonstrated what we can do, and what we're going to do with the capital is refine our rules, improve our ongoing science, build a marketing and sales organization, first to reach out to RIAs and institutions, particularly pension plans, and scale our platform so that users can navigate it intelligently and easily and have a user interface that's easily manageable. We're raising $20 million in a 506c offering. I'm happy to report our first friends and family went out at $1. Then we had one institution that took $500,000 at $5, and subsequent discoveries and technology has improved it to the point where we're raising money at $10 a share, which is an $85 million pre-money market cap. I'm happy to answer any and all questions. Thank you for your time.